Let's start off with the overall market picture. I mentioned the initial jobless claims number came in slightly higher. ADP yesterday, though, surprised to the upside, and everyone's going to be looking forward to the non-farm payrolls number, and that should be quite telling about where we should be going on the equity front.
Yeah, I think unemployment numbers will probably be the dark horse for 2011, and up to this stage the general economic numbers have been quite supportive and solid, but we haven't seen a turnaround yet in the labour market yet, and that's quite telling because it is generally a lagging indicator, and when it does eventually turn, it is generally a sign that things have turned and the recovery is on a sustainable footing.
And overall retail sales, as I alluded to earlier, December coming in at 3.1%. Most had expected a rise of 3.4%. A lot of retailers disappointing. Of course, we can blame it on the weather as well this time round.
Yeah, I think we saw the weather over the eastern seaboard of the United States was particularly bad. There were reports that lots of people were switching to online shopping for their Christmas shopping, but clearly sales not as good as anticipated.
Let's touch on the coal price. I mean, we're seeing the troubles that Eskom is going to have over the next couple of years, and a higher coal price is not going to make things easier. Floods in Australia creating havoc with the supply chains going forward. Would this mean any kind of buying opportunity for some of the coal stocks in South Africa?
Yeah, I think back on the back of that news, most shares that would have been impacted have been impacted quite significantly. In terms of the coal price itself, we saw Richards Bay coal move from a price of about $110 per tonne to $130 quite briefly over a 2-week period or so, and it has subsequently fallen down, and that's largely because of the floods in Queensland, as you mentioned, and that area is responsible for about 30% of the world's seaborne coal exports, and that's clearly going to have an impact on supply going forward. I see there were some brokers' notes today saying that they're expecting the next quarterly price increases for coking coal to be up by 30%. So there will be some companies that benefit from that locally. We've seen Coal of Africa, their share price has probably jumped about 20-25% over the last 3 or 4 days. Exxorro has also been particularly strong. About 45% of their business is driven by coal, and second liners like Centrula, although they don't produce great quantities of coal at the moment, they have mineral rights or in the process of being awarded mineral rights in Mpumalanga, and they've got interests in great coal reserves in Botswana.
Okay, great opportunities lie ahead, it seems, in that sector. What other sectors on the JSE would you be looking out for? It seems that most sectors are fully priced. I spoke to Simon Brown yesterday, and he was talking about the construction industry being quite an interesting play.
Yeah, I think what sectors are going to be attractive. Clearly, the sectors that are going to have the biggest growth in terms of earnings will be the construction shares. First of all, they're going to see they would have seen a massive increase in demand, and then secondly, we've seen a nice rebound in the underlying prices for spot commodities. So for 2011, we're probably likely to see 30, 40, 50% increases across the board there for the likes of Anglo, Billiton, all the other companies in the Anglo stable that are listed, and that's likely to drive those companies. I guess to some degree that isn't priced in many of those share prices, and I think that will probably be the sector where we're likely to see the greatest earnings growth this year.
I also know that you're interested in the likes of ArcelorMittal and Old Mutual purely because of their dismal performance last year. Yeah,
I wouldn't say that we Mittal would be one that we're interested, but just if one looks at the laggards from last year in the top 40, ArcelorMittal is there. We've preferred to be invested in Exxorro, but Old Mutual is an interesting case. That was one of the worst performers in the top 40 last year. Obviously, it was caught up because it has a London listing, operations in London. It was caught up in the contagion that emanated from Europe. But I think it hasn't been a great business over the last 10 or 12 years. There have been some management changes there, and when you see a business trading at a 30% discount to embedded value on a forward PE of under 7, it definitely warrants some further interest, and I think it looks quite exciting at these levels. You asked on the construction shares as well, and that's a question we've been asking ourselves quite on quite a few occasions, because from a valuation perspective, they certainly look cheap. They're trading sort of 5, 6, 7 times forward earnings, and for most of them, cash on balance sheet probably represents about 50% of market cap. So there's certainly a large cash a large element of a cash underpin there. But the great question is, what's happening with earnings, and typically the margins in that sector can go from 0 to 8%. They're probably at mid-cycle sort of levels. I don't think there's been much activity on the construction front since the World Cup. So I think there's ever a probability that the risk to earnings is on the downside.